Hello, friends. Today I am giving you an update on Chevron Corporation, ticker symbol CVX. We'll be looking at the stock performance in the last couple of months and years. Then we'll look at a couple of news. We'll look at Chevron Corporation earnings report, and then we'll look at the performance of the last 10 years and give you an updated fair price. Welcome to Money Talks with Martin Reyes, where we learn to take care of our money and find great companies at great prices. Chevron is a oil company. If you would like to know a little bit more about it, I made a whole explanation in the previous video. I will leave a link in the description below. But it's a company that produces oil and is very connected with the oil companies. I just published not too long ago also about Exxon, and I'll let you know. I told you how I used to own this company too, Chevron, but I sold them because part of the reason is because I don't like the cyclicality of this company. I'm looking right now. I'm moving my strategy to find more growth companies that have great quality on them. So Chevron doesn't meet that criteria just because it's a cyclical company that is more in line with a commodity. When it comes to the last 5 days, Chevron is down 0.4%. Point 0.4%. The last month is up 8%. The last year is down almost 4%, and the last 5 years is up 30%. Analysts believe that Chevron is a buy, and their target price is of $181, which will give it a upside of close to a little bit above 17%. They pay a dividend of $6.52, which is somewhere the current price that will be at 4.2% yield. Their PE ratio is 13.6 times earnings, with a forward PE of 12.4 times earnings. Our great mentor, Warren Buffett, just reported their latest earnings report. I think it was this past week. And one of the things that were notable was that they trim Apple and HP, among some others, and then they load up on Sirius XM and Chevron. So I am no Warren Buffett, but Warren Buffett has been, he's way smarter than me. He definitely is better investor than I am. So he understands Occidental, which he has been buying a lot of, and now Chevron. So good. If you are able to understand, if you have a mind like him, and you understand why I should be maybe reconsidering Chevron, I will just encourage you to leave me a comment down below. Let me know what I'm missing, what your bull case for Chevron is. I know they're purchasing another company. I don't remember what the company right now is, and that is supposed to give them a better market and better production, especially in the area close to Texas, in Texas. So the latest quarter report was on February 2nd. They beat on normalized earnings, but they missed by a lot on GAAP EPS. They missed almost. They reported $1.22, and they missed by $1.59. So that's way past the 50% mark. Actual revenues came down at $47 billion, which means that they missed by $6 billion, which that's quite a significant number. They're estimated to report again on the last week of April, and they the analysts are looking for an EPS normalized close to $3 and revenues of 50.6 billion dollars. EPS has been revised 5 times up in the last 90 days and 15 times down. So, yeah, if you like my comments and my ideas, if you would like to be notified whenever I post a new video, please subscribe, leave a like. That helps the channel. That's one of the many ways that you can support our YouTube channel. If you're listening to it in podcast, please subscribe so that you can also get a notification whenever I post one of these videos. When it comes to the past performance, once again, Chevron is a very cyclical kind of company. It goes up and down with the oil prices. So just like in ExxonMobil, these growth rates are a little bit deceiving. So you have the 5-year at 7% and 10-year close to zero. And gross margins are a little better than ExxonMobil at 31%. I think ExxonMobil was in the low 20s, so that's pretty nice. Earnings, here's if I know some people like to compare Exxon and Chevron. ExxonMobil only had one down year, one negative year. Here we see that Chevron has two. However, their earnings, generally speaking, are a little closer together. There are not too many highs and down. In the last 5 years, says that the growth rate is 49%. That is very deceiving because it's taking a very low year and comparing it with a kind of high year. The last 10 years, about 1%. Profit margins of 10%. I believe ExxonMobil was close to 7%. So these still better margins. Free cash flow margins also, it has been negative in many years, already close to zero in many years. Free cash flow margins average of 9.4%, but that is highly influenced by these two big days numbers on 2021 and 2022. So this is part of the issues that I have with this kind of companies. It's really hard to evaluate because it's just very cyclical. Even here, the book value, you can see that it goes up and down. In the last 10 years, it's pretty much flat. It's a little bit down 1%. CAGR, these are CAGR numbers. Return on equity, it's also up and down, but right now it's at 9% for return on equity, 6.5% at return on assets, and close to 8% on return on invested capital. Dividend, we're flat for quite a while, now has picked up. So that's why in the last 5 years, the number is a little greater at 6.4%, and in the last 10 years at 4.3%. Right now, the payout ratio stands at 57%, which is pretty decent. When it comes to the debt to free cash flow average, this is a little bit inflated, but it would be a 1.5 shares. Oh my gosh. It's all over the place. They buy, they issue more. It just goes up and down, up and down. And I wonder if a lot of this has to do with acquisitions. They're about to make another acquisition, so it's gonna probably go up again. So I don't know what to do with this. When it comes to summary of all the numbers, we can see that the trailing 12 months, they have really improved numbers. Their margins are higher. The free cash flow margin actually are lower, but this is something that I will encourage you to look at. And it's very hard to evaluate a company that is all over the place. But however, I'm going to try to do that. So I'm going to give you my disclaimer. Remember that I'm just a YouTuber. I'm just giving you my opinion. This is not financial advice. This is for educational purposes or entertainment purposes. I hope that you're having fun with everything that I'm telling you. Do not make any financial decisions based on my opinions. Do your own diligence. And here are the numbers. When we look at the historical multiple valuations, we are looking at a fair price somewhere between $123 to $127. When we look at the revenue-based valuation, we're looking at 124, close to $125. If, remember, this valuation system requires the company to be a little more consistent. And these companies are not, ExxonMobil and Chevron are not consistent. They're cyclical. So I will take this with a grain of salt. Same thing. I mean, most of my valuation systems, this is what I get frustrated about. This is that a lot of my valuation systems, they are for companies that are regular, that have regular growth or at least a little predictable growth, not cyclicals like this. So that's why you will see that my fair value on discounted earning valuation is somewhere between $60 and $83, which I know you will think that that is crazy. And part of the reason is because I require a 15% minimal return discount. When we look at the payback time, we're looking somewhere between $65 and $127. Discounted free cash flow, which is all over the place too, requiring a 15% discount. That will give us somewhere between $45 to $90 of a fair value. I will not be using owner's earnings valuation like I mentioned with ExxonMobil because it's not the best. When we put everything together, we are looking at, actually, I forgot that I said I'm not going to use this. So that gives us a average fair number of $97 based on my assumptions. So please let me know what I'm getting wrong. Let me know down in the descriptions how much you disagree with me. However, if you would like to do your own numbers, I will encourage you to go to Buy Me a Coffee, get a copy of this valuation sheet, plug your own numbers, and maybe that will help you come up with a better analysis than this. Looking forward to hearing your point of view, and I hope to see you in the next video.